What to avoid besides gold? While we're at it, let me tell you what else to avoid in 2026: Bitcoin and crypto. If you think gold is bad because it's unproductive, Bitcoin is worse. At least gold has some industrial uses and 5,000 years of history as a store of value. Bitcoin has neither. It's rat poison squared. As I've said before, when the gold bubble pops, cryptocurrencies are likely to be hit even harder. Gold mining stocks. Some people think they're being clever. Instead of buying gold, they'll buy gold mines to get leverage to the gold price. That works great on the way up. On the way down, it's a disaster. Miners have operating costs, debt, execution risk, and political risk. When gold collapses, mining stocks typically fall twice as hard. We bought Barrick Gold briefly in 2020. It was a specific tactical trade during COVID uncertainty. We sold it in 6 months. That should tell you something about how I view the sector long-term. Long-duration bonds, with rates potentially staying higher for longer and inflation remaining a concern. Long-duration bonds, 20 to 30-year treasuries, are risky. If you want fixed income, stick to short-term bills and high-quality corporate bonds with durations under 5 years. The Buffett 2026 portfolio. If I were advising someone with $100,000 to invest in 2026, here's what I'd suggest: 40% in S&P 500 index funds or total stock market, diversified exposure to American businesses, 30% in individual shares of high-quality companies with competitive advantages, 20% in short-term treasury bonds or cash equivalents, safety and optionality, 10% in a farm or real estate investment if you have the expertise. Otherwise, more index funds. Notice what's missing: gold, zero allocation. Now I can already hear the objections. But Warren, what if you're wrong? What if gold keeps rising? What if we get hyperinflation? Let me address this directly. Could I be wrong about timing? Sure. Maybe gold reaches 4,500 or even 5,000 before it crashes. Markets can remain irrational longer than you can remain solvent, as Keynes said. But here's the thing: I'm not trying to time the exact top. I'm telling you that buying gold at 4,000 is a bad investment with poor risk-reward. Whether it gets to 4,500 first or not. As for hyperinflation, the United States has never experienced true hyperinflation in its 250 years of history, even when we abandoned the gold standard in 1971. Why? Because we have an independent Federal Reserve, a diversified economy, and the dollar remains the world's reserve currency. We might get 5 to 7% inflation. Sure, but that's not hyperinflation, and even in that scenario, productive businesses that can raise prices will outperform gold over time. Weimar Germany had hyperinflation. So did Zimbabwe. So did Venezuela. Those are countries with collapsed governments, destroyed productive capacity, and no credible institutions. That's not the United States, and it's not going to be the United States in 2026. Let me share a final thought. Throughout my career, I've learned that the best time to invest is when you can buy productive assets at reasonable prices. The worst time to invest is when you're buying unproductive assets at unreasonable prices, because everyone else is doing it. Gold at $4,000 an ounce is the epitome of buying an unproductive asset at an unreasonable price because everyone else is doing it. It's a textbook bubble. Meanwhile, there are wonderful businesses trading at 15 to 20 times earnings, generating billions in free cash flow, returning money to shareholders, and positioned to thrive for decades. Why would you choose inert metal over the money machine? I've been investing for over 70 years. I've seen numerous bubbles: the Nifty 50 in the early 1970s, Japanese stocks in 1989, tech stocks in 2000, housing in 2007, Bitcoin in 2021. They all had the same characteristics. 1. Parabolic price increases disconnected from fundamentals. 2. Universal bullish sentiment and dismissal of skeptics. 3. New paradigm. Narratives explaining why traditional valuation doesn't apply. 4. Late-stage retail investor participation. 5. An inevitable painful collapse. Gold in 2025 checks all 5 boxes. The crash is coming. The only question is exactly when and how severe. Here's what I want you to remember when the crash comes, and it will come. The history of markets is the story of fear and greed oscillating between extremes. Right now, fear has driven gold to 4,000. But fear is a terrible investment thesis because fear eventually subsides. When it does, prices collapse. I learned something from Ben Graham that served me well for 70 years. In the short term, the market is a voting machine. In the long term, it's a weighing machine right now. The votes are for gold. Everyone's voting for it because everyone else is voting for it. But eventually, the market weighs assets based on what they actually produce. And gold produces nothing. The weighing machine will be brutal for gold holders. Here's what I want you to understand. This isn't about being right or wrong about gold. This is about opportunity cost. Every dollar you have in gold at 4,000 is a dollar you don't have in productive assets. Over time, that opportunity cost compounds into enormous sums. If gold goes nowhere for the next 10 years, just stays flat at 4,000, you've gotten zero return while productive assets compound at 7 to 10% annually. That's not a small difference. That's the difference between $100,000 becoming 100,000 or 250,000. That's the difference between a comfortable retirement and a magnificent one. And if gold crashes, which I believe it will, the opportunity cost is even worse because you're starting from a lower base. I want you to ask yourself a question. What story are you going to tell yourself in 2027 when gold is at 2,200 and the S&P 500 is 20% higher? Are you going to say, well, Warren Buffett warned me but I didn't listen? Or are you going to say, I recognized the bubble, I sold near the top, and I deployed my capital into productive assets? The choice is yours, but the window is closing. Gold at 4,000 is a gift, not for buyers but for sellers. I've lived 94 years through countless market cycles. I've seen bubbles inflate and explode. I've made mistakes, and I've made good decisions. But one thing I've never regretted is avoiding speculative manias and sticking to the basics. Buy productive assets at reasonable prices and hold them for long periods. That boring strategy has served me pretty well. It will serve you well too. When you're tempted to buy gold because everyone says it's going to 5,000, remember this. The crowd is usually right during the trend and wrong at both extremes. We're at the extreme. Smart money is already positioning for the exit. Don't be the person left holding the bag when the music stops. Be the person who recognized the bubble, acted rationally, and deployed capital where it could actually grow. Your future self will thank you. So there you have it, friends. The great gold crash of 2026 is coming. Maybe it starts in the first quarter, maybe in the second, maybe in the third, but it's coming as sure as night follows day. Gold at $4,000 an ounce isn't a safe haven. Institutions know this. That's why you're seeing subtle shifts in positioning. Hedge funds are starting to trim positions. Smart money is taking profits. They're not announcing it. They're just quietly selling into strength. Let me tell you about some other indicators I'm watching that suggest we're near a top. First, media coverage. When you start seeing gold on the covers of major magazines, when cable news shows are doing special segments on how to buy gold, when your friends who never invest are suddenly talking about their gold positions, that's a classic contrary indicator. Second, advertising. I'm seeing more gold company ads than ever. Late-night TV commercials, radio ads, internet ads, all telling people to buy gold before it's too late. When sellers are aggressively pushing a product, it's usually because they know the window to sell at high prices is closing. Third, sentiment metrics. Various investor surveys show record optimism about gold. Everyone is bullish. When that happens, ask yourself, who's left to buy? If everyone who's going to buy has already bought, the only move possible is down. Fourth, the gold to silver ratio. Historically, gold trades at 50 to 70 times the price of silver. Right now, with gold at 4,000 and silver around 30, the ratio is approximately 133. That's extremely high historically. It suggests gold is overvalued relative to its precious metal cousin. Fifth, gold versus other assets. Compare gold's price to other real assets. Against oil, against copper, against wheat. By almost every measure, gold looks expensive relative to other commodities. That suggests its price is being driven by speculative sentiment, not fundamental supply and demand factors. Now let me address the argument that gold is an inflation hedge. This is one of the most common narratives, and it's largely a myth. Yes, gold rose during the inflationary period of the 1970s, but it also crashed afterward. From 1980 to 2005, gold basically did nothing while inflation continued eroding purchasing power. If you bought gold in 1980 as an inflation hedge, you spent 25 years watching inflation eat away at your purchasing power anyway. Because gold was falling in nominal terms. Compare that to real businesses with pricing power. Take Coca-Cola, which I've owned for decades. When inflation arrives, Coca-Cola can raise the price of a can of soda 5 to 10% and people still buy it. Same goes for our other holdings like American Express, Apple, our utility companies. These businesses produce real goods and services that people need and want, and they compound value over time. Or look at treasury bonds. If you buy a 10-year treasury, you know your exact return. It's guaranteed by the US government. It's not exciting, but it's real. With gold, you have no cash flow, no guarantees. Just the hope that someone will pay you more tomorrow than you paid today. That's not a hedge. That's speculation. Let me share a thought experiment I use often. Imagine you had $10,000 to invest in 1990. One option is to buy gold. The other is to buy the S&P 500 with reinvested dividends. With gold, your $10,000 would now be worth about $55,000 before accounting for storage costs. Not bad. With the S&P 500, your $10,000 would now be worth approximately $300,000. If you'd put it in Berkshire Hathaway, you'd have even more. The difference? Gold just sat there. Businesses grew their earnings, returned cash to shareholders, adapted to changing markets, innovated, and compounded value year after year after year. In 2026, when gold is collapsing, these businesses will still be selling their products, generating cash flow, and creating value. That's what you want to own. So if not gold, what? That's the right question. I don't believe in just telling people what not to do. I believe in offering better alternatives. The antidote to inflation, which is supposedly driving people toward gold, isn't gold. It's businesses with pricing power. Companies that can raise prices without losing customers. Look for companies with strong brands that command pricing power. High returns on invested capital, 15% plus consistently. Low debt levels so they can weather any storm. Management teams that allocate capital intelligently. Products or services with decades of runway ahead. These are the types of businesses I own in Berkshire. These are the types of businesses I'd recommend to any long-term investor. Short-term treasury bonds. Here's something that will surprise you. Right now, with interest rates where they are, you can get 4 to 5% risk-free on short-term treasury bonds. That's guaranteed by the US government. Compare that to gold, which pays you nothing and has substantial downside risk. For conservative investors, this is a no-brainer. Take the bird in hand. When I'm sitting on cash at Berkshire, we hold treasury bills. They're liquid, they're safe, and they generate a return. In 2025, our treasury holdings earned us billions in interest. Gold would have earned us exactly zero and exposed us to principal risk. As we move into 2026 and gold collapses, that guaranteed 4 to 5% return will look pretty smart compared to a 40% loss. Real estate and farmland. Remember my bucket analogy? For the price of all the gold in the world, you could buy all the farmland in America plus the best companies. That wasn't a joke. That's what I'd actually do. Farmland produces crops. Those crops feed people. Last time I checked, humans need to eat. Farmland has value. The same farmland that produced corn in 1950 is producing more corn today. Thanks to better techniques, better seeds, better fertilizers. It's a productive asset. Gold produced nothing in 1950 and produces nothing today. Same ounce, same nothing. If you're looking for inflation protection, high-quality farmland in the United States is a far superior option to gold. You get rental income from farmers. You get appreciation as global food demand grows. You get a tangible asset that has real utility. The same logic applies to well-located real estate. A good apartment building in a growing city will generate rental income year after year and appreciate over time as the area develops. It's productive capital, not inert metal. Your own business or skills. Here's the best investment most people can make. Invest in yourself. Improve your skills. Start a business. Buy a franchise. Do something that generates cash flow and can grow over time. I started with $10,000 in the 1950s. I didn't buy gold. I invested in securities. I learned from Ben Graham. I bought businesses and focused on compounding over decades. That $10,000 turned into tens of billions because it was deployed in productive assets. That grew. If you're young, the best time to make yourself more valuable is right now. Learn to code. Learn to sell. Learn to manage people. Learn to trade. Those skills will generate returns for decades. Gold won't teach you anything except how to watch a ticker and feel anxious. Let me give you an analogy. Imagine a theater full of people watching a movie. Everything is calm. Then someone yells fire. It doesn't matter if there's an actual fire or not. The crowd rushes to the exits. People trample each other. It's pure panic. That's what happens when sentiment shifts in a momentum-driven market like gold. You don't need a massive fundamental event. You just need enough people to decide to take profits at the same time. So what could be the trigger? There are several candidates. An inflation print better than expected showing prices are actually falling month over month. A surprise resolution of geopolitical tensions. Perhaps a trade deal between the US and China, or a ceasefire in some regional conflict. Simply gold reaching 5,000 and stopping its rise, which would trigger traders to take profits. The Federal Reserve pausing rate cuts, or even suggesting it might need to raise rates again. If inflation remains persistent, a stronger US dollar driven by US economic growth outpacing Europe and China. Any of these could be the pin that pops the bubble. And once it starts, it will be a cascade. First, the leveraged speculators will exit. These are hedge funds and traders who've borrowed money to bet on gold. According to COMEX data, net long non-commercial positions, basically speculators, reached record levels in 2024 and 2025. When prices start falling, they get margin calls. They're forced to sell. That selling creates more selling. Then come the gold ETFs. Right now, gold-backed ETFs hold around 3,600 tons. That's substantial, but it's still below the 2020 peak of 3,925 tons. ETF investors are momentum players. They buy when prices rise and sell when prices fall. If gold drops 10 to 15% from its highs, you'll see massive ETF outflows. The World Gold Council's own analysis suggests ETF holdings could decline by 300 to 500 tons in a bearish scenario. That's equivalent to $20 to $30 billion of selling pressure. Then come the retail investors. These are people who bought gold because their neighbor made money, or because they watched a YouTube video saying it was going to 10,000. They don't have strong convictions. They don't really understand why they own gold beyond the fact that the price was going up. The moment they're down 20%, panic sets in. They sell at the worst possible time, accelerating the decline. This is exactly what happened in 2013. After gold reached 1,900 in 2011, it traded sideways for a couple of years. Then in April 2013, it crashed $200 in 2 days. ETFs saw record outflows. Retail investors capitulated. By June 2013, gold was below 1,300, a 37% drop from the peak in less than 2 years. The same pattern will repeat. It always does. Now let's talk about timing. I can't tell you the exact date the crash will begin. Nobody can. Markets can remain irrational longer than anyone can foresee. Gold could reach 4,500 or even 5,000 before it falls. But I can tell you with a high degree of confidence that sometime between now and the end of 2026, we'll see a major correction. It will probably begin in the first or second quarter of 2026, because that's when several factors converge. First, the Federal Reserve's policy cycle. By early 2026, we'll have clarity on the inflation trajectory and interest rates. If inflation continues moderating and economic growth remains solid, the perceived need for safe havens diminishes. Second, The election year in the United States will be over. Many of the current political fears will be resolved or at least clearer. Uncertainty feeds gold prices. Certainty, even certainty about bad news, tends to reduce them. Third, seasonality. Historically, gold tends to underperform in the second and third quarters of the year when investment interest wanes. Fourth, simply rally fatigue. Gold has risen relentlessly for over a year. Even the most committed bulls eventually take profits when the crash begins. I predict it will be fast and brutal. Gold could drop 10% in a week, 20% in a month, 40% in 6 months. I've seen this happen twice before. It will happen again. How far could it fall? Looking at fundamentals, the all-in sustaining cost to extract an ounce of gold is currently around $1,200 to $1,400 depending on the mine. Historically, gold rarely trades below production costs for extended periods because miners simply shut down operations, reducing supply. Using historical averages, gold typically trades at 15 to 20 times the all-in sustaining cost. That math suggests a fair value range of $1,800 to $2,400 per ounce under normal market conditions. But we're not in normal market conditions. We're at peak euphoria. And when euphoria turns to desperation, prices often overshoot to the downside, sometimes significantly below fair value. I wouldn't be surprised to see gold touch $2,000 to $2,200 in a full correction. That represents a 45 to 50% drop from current levels, similar to what we saw after the 1980 and 2011 peaks. Now I know what some of you are thinking, but Warren, you've always been against gold. You've never liked it. You're biased. You're right. I don't like gold, but this isn't about my personal preferences. This is about math and market psychology. Let me show you the numbers. From the year 2000 to 2025, gold has risen from about $800 to $4,000. That's a 1,329% return, or about 11% annualized. Sounds great, right? Now look at the S&P 500. During the same period, it went from 1,320 to around 6,500. Including reinvested dividends, it's actually much higher. That's approximately 7.5% annualized in price terms alone. But with reinvested dividends, you're looking at 9 to 10% total returns. Plus, you own productive businesses that were increasing their earnings every year. And look at Berkshire Hathaway. I'm not trying to toot my own horn here, but our shares have compounded at approximately 10% annually during the same period. And shareholders own a piece of real businesses generating billions in annual profits. The only period when gold massively outperformed was from 2008 to 2011, during the acute phase of the financial crisis and its immediate aftermath. But even then, if you bought gold in 2011 thinking the rally would continue, you lost money for the next 4 years while stocks tripled. Here's what really concerns me. People who bought gold at $4,000 didn't buy it because they analyzed the fundamentals. They bought it because the price went up. That's not investing. That's speculation. That's chasing momentum. And momentum works until it does and single quotes T. I want you to think about this carefully. If you own gold at $4,000 an ounce, ask yourself, what's my upside from here? Say gold reaches $5,000. That's a 25% gain. Nice, but hardly life-changing. Now ask yourself, what's my downside? If gold repeats 1980 or 2011, you could lose 40 to 50%. If it simply reverts to pre-COVID average levels around 1,500 to 1,800, you're down 55 to 60%. That's not a good risk-reward setup. In my world, you want investments where you can make $3 for every dollar you risk. With gold at current levels, you're risking to make $1. That's upside down. Here's where it gets really interesting. And this is the question I want burning in your mind for the next few minutes. If gold crashed so brutally in 1980, destroying the wealth of an entire generation of investors, why did millions of people make the exact same mistake just 30 years later? What is it about human psychology that makes us forget these painful lessons so quickly? And more importantly, why are we doing it again right now in 2025? Watching history repeat itself with mathematical precision, yet somehow believing this time is different. Let's jump forward 3 decades to 2008. Gold was trading around $700 an ounce. Then came the global financial crisis. Lehman Brothers collapsed. AIG was bailed out. The stock market plunged 40%. Panic gripped the markets. The Federal Reserve began quantitative easing, essentially printing money to stabilize the financial system. And once again, the prophets of doom emerged, proclaiming the end of the dollar, the end of the financial system, the inevitable collapse of Western civilization. Once again, gold became the favorite refuge. It rose from $700 in 2008 to $1,900 in September 2011. Another spectacular rally fueled by pure fear. Analysts were saying it was heading to $5,000. They said quantitative easing would cause hyperinflation. They said the dollar was finished. They said U.S. Treasury bonds were worthless paper. Once again, we watched from the sidelines. Once again, we didn't buy gold. Well, that's not completely true. In 2020, during the initial COVID panic, we bought some shares of Barrick Gold. It was a short-term tactical bet based on specific market dynamics. We held it for less than a year and sold it. That should tell you everything you need to know about my long-term view of gold and gold mining stocks. Going back to 2011. What happened after gold reached 1900? Exactly the same thing that happened after 1980. The crisis resolved. The financial system stabilized. The feared hyperinflation never arrived. The U.S. economy recovered. Companies became profitable again. Stock markets began a 9-year bull run. And gold, well, gold fell. By 2015, it was at $10.50, a 45% drop from its peak. Again, people who bought at the top waited years to break even, if they ever did. And now we're here in 2025, and history is repeating itself for the third time. Gold has risen from $2,500 to $4,000 in 12 months. Bullish sentiment is universal. The same banks, the same analysts, the same predictions of $5,000, $6,000, $10,000. The same narratives about the collapse of the dollar, runaway inflation, the end of the financial system. Except this time, the narratives have new twists. This time is different, they say, because of de-dollarization. China and Russia are creating alternative payment systems. The BRICS are talking about a gold-backed currency. Trade tariffs are fragmenting the global economy. National debt has surpassed $36 trillion. The budget deficit is $2 trillion annually. Political polarization is at historic highs. The global financial system is more fragile than ever, and therefore, gold is the only protection. Let me address each of these arguments systematically, because each one is either flawed, irrelevant, or both. First, de-dollarization. Yes, China and Russia have been trying to reduce their dependence on the dollar. This is not new. They've been trying for 15 years. What's been the result? The dollar still represents 58% of global currency reserves. It's still the dominant currency in international trade. Most commodities, from oil to wheat, are still priced in dollars. The U.S. Treasury bond market remains the largest and most liquid in the world. When there's a crisis, capital still flees to dollars, not away from them. The reality is that creating an alternative to the dollar is extraordinarily difficult. It requires deep capital markets, rule of law, independent institutions, transparency, and global trust. China has capital markets, but they're state-controlled. It has institutions, but they're not independent. It has a massive economy, but it doesn't have the rule of law that international investors demand. The yuan represents only 2.7% of global reserves, despite China being the world's second-largest economy. Why? Because nobody fully trusts that the Chinese Communist Party won't manipulate its currency or freeze their assets if a political conflict arises. As for Russia, its economy is smaller than Italy's. The ruble is basically irrelevant in global markets. The idea that Russia will lead some de-dollarization movement is absurd. Second, national debt. Yes, the United States has $36 trillion in debt. As a percentage of GDP, it's around 120%. That's high. But you know what was higher as a percentage of GDP? U.S. debt in 1945, after World War II, was 119% of GDP. What happened next? The United States grew its way out of that debt. The economy expanded massively in the 1950s and 60s. Tax revenues grew. The debt-to-GDP ratio fell to 30% by the 1970s. It wasn't because the U.S. paid off all its debt. It was because the economy grew faster than the debt. That can happen again. The United States has the most dynamic economy in the developed world. It has the best universities. It attracts the best talent. It leads in technology, finance, entertainment, agriculture, energy. It has rule of law, property protections, deep capital markets. It has all the ingredients for continued growth. Is debt a concern? Of course. Does it justify paying $4,000 for an ounce of gold that produces nothing? Absolutely not. Third, inflation. This is interesting because the narrative has shifted. In 2021 and 2022, when inflation hit 9%, the gold narrative made sense superficially. Gold is an inflation hedge, they said. But now, in 2025, inflation has fallen to around 3 to 4%. It's moderating, not accelerating. So why is gold exploding in 2025 when inflation is falling? The answer is pure psychology, momentum, residual fear. People seeing the price go up and assuming it must keep going up. It's not economics, it's speculation. Now let me tell you about something that really concerns me: the behavior of central banks. As mentioned, central banks bought over 900 tons of gold in 2024 and were on track for similar purchases in 2025. This has been a key pillar supporting the gold price. But here's what the analysts are telling you. Central bank purchases are slowing down, not accelerating. Data from the World Gold Council shows that monthly purchases in the second half of 2025 have been substantially lower than in 2024. In July 2025, central bank purchases were only 10 tons, the lowest monthly figure in years. Why? Because central banks aren't fools. They were buying gold when it cost $1,000, $1,500, even $2,000 an ounce. At $4,000, they're reconsidering. Ask yourself this: if you were the central bank of China or Russia or India, would you rather buy gold at $1,200 an ounce or at $4,000 an ounce? The answer is obvious. Everyone prefers to buy cheap. At current prices, central banks are being cautious. And when your largest marginal buyer starts pulling back, that's a warning sign the size of Texas. But there's an even more alarming scenario that nobody is contemplating. What if a major central bank decides to sell gold? Not much. Just 100 tons to raise cash for urgent fiscal needs or to defend their currency in a crisis. The psychological impact would be devastating because it would signal that even the most committed institutional holders are taking profits. Gold doesn't have a calculable intrinsic value like a stock or bond. Its price is purely a function of supply, demand, and most importantly, sentiment. When sentiment shifts, it can shift rapidly. What if I told you that the smartest investors on Wall Street are quietly positioning themselves for what could be the most devastating wealth transfer of this decade, and you're about to be on the wrong side of it? Right now, while you're watching this, gold is trading at $4,000 an ounce. Every financial news channel, every investment guru, every bank analyst is screaming that it's going to 5,000, 6,000, maybe even 10,000. They're telling you this is your last chance to protect yourself before the dollar collapses, before the financial system implodes, before everything you know about money changes forever. But here's what nobody's telling you. I've seen this exact movie twice before, and both times it ended with ordinary people losing everything they worked their entire lives to build. I'm talking about life-changing, retirement-destroying losses that could have been avoided if just one person had told them the truth. So let me be that person for you today. My name is Warren Buffett. I've been investing for over 70 years. I've survived more market crashes, more bubbles, more financial panics than most people will read about in history books. And what I'm about to tell you isn't based on theory or speculation. It's based on cold, hard mathematical certainty and the brutal repetition of human psychology that never, ever changes. The gold bubble of 2025 is about to explode. And when it does, it's going to make the housing crash of 2008 look like a minor correction. The only question is whether you'll see it coming. or whether you'll be one of the millions holding the bag when the music stops. Let's start with what's happening right now. Gold was trading at $2,500 just 12 months ago. Today it's at $4,000. That's a 60% gain in 1 year. The world's biggest banks, JP Morgan, Goldman Sachs, Deutsche Bank, Credit Suisse, they're all publishing reports predicting gold will hit $5,000, even $6,000 per ounce in the next 12 to 18 months. Central banks around the world are hoarding gold like it's the last lifeboat on the Titanic. China bought 300 tons in 2024. Russia bought 250. India, Turkey, Poland, the Czech Republic, they're all buying. The numbers are staggering. In total, central banks acquired over 900 tons of gold in 2024, the largest accumulation since they started keeping consistent records in 1950. Gold ETFs are seeing record capital inflows, billions of dollars flowing in every single week. Long positions in gold futures on the COMEX reached levels never seen before. Gold coin dealers in major cities are reporting they can't keep up with demand. Pawn shops are buying gold jewelry at premium prices. YouTube is flooded with videos proclaiming gold will reach $10,000, $20,000, $50,000 per ounce. Investment forums are boiling over with stories of people who doubled or tripled their money in 6 months. I see advertisements everywhere telling people to buy gold, that it's the only protection against the imminent collapse of the dollar, against runaway inflation, against the financial apocalypse that's supposedly just around the corner. And here's what nobody is telling you. I've seen this movie before. I've seen it twice, to be exact, and each time it ends exactly the same way, with a brutal crash that destroys the savings of millions of people who bought at the top, because someone convinced them that this time was different. Let me take you back in time to 1980. I was 49 years old. I'd already been investing professionally for more than 2 decades. Gold had started the 1970s trading at about $100 an ounce. It was stable, predictable, boring. Then Richard Nixon closed the gold window in August 1971, effectively ending the Bretton Woods system that had anchored the US dollar to gold. Since 1940, suddenly, the dollar was pure fiat currency, backed only by faith in the United States government. The doomsayers came out of the shadows. They said this was the end, that the dollar would collapse, that the only salvation was gold. And gold started to rise. By 1974, it was at $200. By 1978, $400. By 1979, $600. Then came 1980, and the frenzy reached its peak. The Hunt brothers were trying to corner the silver market, which was causing contagion across all precious metals. Inflation in the United States was out of control, exceeding 13% annually. Mortgage interest rates hit 18%. The price of oil had quadrupled after the Iranian Revolution. Paul Volcker had just been appointed chairman of the Federal Reserve, and markets weren't sure if he could or would do what was necessary to tame inflation. In that environment of absolute panic, gold exploded. In January 1980, it reached $850 an ounce. Adjusted for inflation, that's equivalent to about $3,000 to $100 in today's terms. Analysts were saying it was heading to $2,000, $3,000, $5,000. They said anyone who didn't own gold was a fool. They said the financial system was collapsing and only gold would survive. My partner Charlie Munger and I watched all of this with a mixture of fascination and horror. Fascination because it was a perfect case study in mass psychology. Horror because we could see ordinary people, hardworking folks who had saved their entire lives, betting their life savings on gold at $850 an ounce because some salesman told them it was a safe investment. We didn't buy gold at $100, not at $400, not at $850. Why? Because even then we understood something fundamental that most people don't grasp. Gold produces nothing. It generates no cash flow. It pays no dividends. It doesn't grow or multiply. If you buy an ounce of gold and hold it for 10 years, you still have 1 ounce of gold. Meanwhile, Volcker did exactly what he needed to do. He raised interest rates to 20%. Yes, 20%. It was painful. The economy went into recession. Unemployment surged. But he broke the back of inflation. And when inflation started retreating, when it became clear that the apocalypse wasn't coming, that the dollar wasn't going to collapse, that the financial system would survive, gold crashed. By 1982, it was below $300, a 65% collapse from its peak. People who bought at the top in 1980 didn't see their money back in nominal terms until 2008. That's 28 years of waiting, almost 3 decades watching your investment languish while the world kept turning, and productive businesses generated wealth, and the stock market multiplied tenfold. But the story doesn't end there.